It's a burning debate right now about Tata Motors.
Ladies and gentlemen, the Indian stock market is buzzing with debate.
The countdown is on as Tata Motors is set to complete its much-awaited demerger.
That is kicking in on October 1st.
The company is dividing into two separate listed entities.
First one, Tata Motors passenger vehicle, and second one would be Tata Motors commercial vehicle.
And after 80 years of operations, Tata Motors is finally undergoing a demerger. Now think about it. This is a company that fought through the 2008 financial crisis while Jaguar Land Rover was bleeding billions, and it clawed its way back from 48,000 crores in crushing debt to become completely debt-free by 2025. Today, Tata Motors stands at a record profit of 28,000 crores. That's more in profits in 1 year than the entire market value of companies like Britannia or Godrej Consumer.
A group built on a foundation of trust and ethics. The Tata Group is India's most respected and best-known business group in the private sector.
But at the peak of this success, they are taking a knife and voluntarily cutting themselves apart. On one hand, this demerger could unlock tens and thousands of crores in hidden shareholder value. On the other hand, this move introduces entirely new complexities, new vulnerabilities, and new risks that could put both Tata entities in dangerous positions when crisis strikes. And what happens next will determine whether Tata Motors will go on to become a Harvard business case study on value creation or a cautionary tale about value destruction.
From Tata Motors, you can assume that this much of a value will get chopped off because Tata Motors CV business will get dormant and will not be allowed to trade.
Tata Motors is not in my list of things, in my preferred auto stocks.
Which is why we did a deep dive to help you understand why is Tata Motors, a highly profitable debt-free company, choosing to demerge itself apart right when everything is going well. What are the hidden benefits that could unlock thousands of crores worth of value for its investors? What are the dangerous risks that could backfire for the Tatas? And finally, as shareholders, what exactly should we be watching to know whether this gamble pays off or falls apart? But before we move on, let me introduce our partners of today's episode, which is Odoo. Let's be real, guys. Managing invoices is usually a nightmare. If you've ever run a business, you know that cash flow lives and dies on invoicing. One missed invoice, one late payment, and suddenly your entire month is upside down. Spreadsheets don't cut it. Emails get lost, and chasing payments is total chaos. That is where Odoo Invoicing helps you out. In just a few seconds, with Odoo Invoicing, you can create and send a professional invoice, choose your customer, add products or services, set billing terms, and email it instantly. Every conversation, note, and follow-up stays linked to that one invoice, so you never lose track. And payments can be done in the smoothest possible way, and your clients can pay online through Stripe, PayPal, Adyen, and more. And when you connect your bank, Odoo automatically updates payment statuses, whether it's paid or overdue, and that too with clear due dates. So you're always on top of your cash flow, and you can keep your business steadily running. And it doesn't stop there. Odoo helps you manage credit notes, integrate supplier invoices, and even customize your invoice layout with your VAT and company details already set up. And here's the best part. Your first app on Odoo, including invoicing, is free for life with unlimited hosting and support. So with Odoo Invoicing, you can create, send, and track invoices faster than ever. Try it today using the link below. To understand this, we first need to study a powerful concept in corporate finance called conglomerate discount. In simple words, imagine you are an investor with 10 lakh rupees to invest, and you are researching two companies. Company A is a pure play infrastructure company that builds roads and bridges. It is steady, predictable, and grows at 8% annually. Investors typically value such companies 12 times their annual earnings. And here's where you need to know something called PE ratio. So the question is, what is PE ratio? Let me explain this with a simple example. Imagine you own a small chai shop that makes 1 lakh rupees in profits every year. Now, if someone wants to buy your shop, how much should they pay you? Well, if they offer you 10 lakh rupees, that's a 10x price to earning ratio, as in 10 times your annual profit. If they offer 15 lakh rupees, that's a 15x PE ratio, as in 15 times your annual profit. But the question is, why would someone pay 15x or 10x your profits? Well, that is because they believe that your chai shop will grow consistently. Maybe you're opening new locations, maybe you have loyal customers, or maybe the chai market is booming. So the faster and more reliably you're expected to grow, the higher the price to earning ratio investors will pay. So stable, slow growth businesses might get 10 to 15x price to earning ratio, whereas high growth businesses get 25 to 35x price to earning ratio. If this is clear, let's come back to our example. So we saw what company A does. Now if you look at company B is an electric vehicle startup that is losing money now, but it is growing at 40% annually. It is risky, but it is exciting. So investors value such high growth companies at 30 times their earnings or 30x price to earning ratio. Now here's where the conglomerate discount kicks in. If these two companies are merged into one, how will the investors value these companies? Well, let's try to understand using a simple math. Let's say company A makes a profit of 100 crores annually and company B makes 50 crores profit annually. So the combined profit is 150 crores. Now, what should the merged company be worth? In scenario 1, if they are valued separately, then they are valued as a sum of their parts. So company A will be valued at 100 crores into 12 equal to 1200 crores and company B will be valued at 50 crores into 30 equal to 1500 crores. Why? This is because while company A is in the infrastructure sector where the PE ratio is about 12, company B is in the EV space where the price to earning ratio that the investors give out is about 30x the earning. Which is why company A is valued at 100 crores into 12 equal to 1200 crores and company B is valued at 50 crores into 30 equal to 1500 crores. So the total value is 2700 crores. But in scenario 2, if they are valued as a conglomerate, here's what actually happens. Now, if both these entities are actually merged together, it actually results into a confusing merger. Because if the investor comes and has a look at this company, the investor will be like, dude, are you manufacturing EVs or are you into infrastructure? Because if you're into EV, you will command a price to earning ratio of 30x. But if you're into infrastructure, you will command a price to earning ratio of 12x. So what exactly should be the price to earning ratio of this merged entity? Because of this confusion, the investors will take a safe stand and they will give it a 16x multiple. Now, if you look at how it reflects on the value of the company, the combined profit is 150 crores and the valuation turns out to be 150 crores into 16 equal to 2400 crores. So the conglomerate discount over here is 2700 crores minus 2400 crores equal to 300 crores in lost value. That's 11% of value that simply vanishes because the businesses are bundled together. This is exactly what was happening to Tata Motors. Let me show you with real numbers and comparisons. You see, before the demerger, Tata Motors housed two completely different businesses. Business 1 was the commercial vehicle business which made trucks, buses and commercial fleets. They had a market share of 37.1% in India and had EBITDA margins of 12.2% and they were competing with Ashok Leyland. Now the commercial companies typically get a price to earning multiple of 15x. But business 2 is the passenger vehicle segment which makes cars and SUVs that account for 13.2% of the market share. On top of that, they also have electric vehicles which command a 53% market share in the EV segment. This business is high growth, technologically driven but capital intensive and it's competing with Tesla, BYD, Mahindra, BMW and Mercedes-Benz. Now in this business, the typical PE multiple ranges between 20 to 35x and for EV, this number could go even higher. Now here's the valuation trap explained with a hypothetical example. Let's say analysts projected that the commercial vehicle business will make 5,000 crores in annual profits. The passenger vehicle business will make 8,000 crores in annual profits. So the total projection is 13,000 crores. Now if valued separately, commercial businesses command 14x valuation and will be valued at 70,000 crores. And passenger vehicle business are valued at 25x, so the passenger vehicle segment would be worth 2 lakh crores. The total value would have been 70,000 crores plus 2 lakh crores equal to 2.7 lakh crores. But as a conglomerate, the market will apply approximately 17.5x multiple to the blended earnings. So the merged entity is valued at 13,000 crores into 17.5x equal to 2,27,500 crores. Now, if you see, simply due to the merged entity, the value being left on the table is about 42,500 crores. All this value could just disappear simply because the market could get confused. Now, the question is, why does this problem happen? Well, that is because of three deadly reasons. The first problem is something called the confusion tax. You see, investors hate confusion. When they can't clearly understand what they're buying, they always pay less for it. Think of it like buying a house. A 3-bedroom apartment has a clear price of 1 crore rupees, and a commercial office has a defined price of 2 crore rupees. But if you are selling a commercial residential hybrid where half is office space and the other half is the living quarters, nobody knows how to price it, right? Is it 1 crore or 2 crore or is it 1.5 crores? If this is the case, then the investors will obviously lowball you and offer you what? 1.2 crores simply because of the uncertainty. This is the same thing that happened with Tata Motors. Problem number 2 is the wrong investor problem. You see, different investors want different things. Conservative pension funds which manage retirement money, they need steady, predictable returns. So if they were to given a choice between EV and commercial vehicle companies, they would obviously choose commercial vehicle companies because they are slower, but they are safer. Similarly, if you go and ask aggressive growth funds, where would they invest? They are obviously hunting for companies like Tesla, and they want 30 to 40% annual returns, and they are willing to take the risk for it. That is the reason why they would choose EVs with explosive growth potential. But the problem is that when both businesses are bundled together, the pension fund says, "Arey Baba, I can't buy this because it has too much risky EV exposure." Whereas the growth fund says, "Arey Baba, even I can't buy this because it's barely growing at 8%, whereas other pure EV companies are growing at 30%. So both investor types reduce their allocation or they skip the investment altogether. This is how reduced demand results into lower stock price than it actually should command. This is the second problem. The third problem is capital allocation distrust. You see, investors constantly worry whether the management will starve the high growth EV business just to feed the mature commercial vehicle business, or sometimes they might worry that the management will actually use the profits of the commercial vehicle segment and take risky bets in the EV sector. So this uncertainty makes them unwilling to pay full price for either businesses. This is how a merged entity actually ends up losing its value simply because of investor confusion and skepticism. These are the hidden dangers of being a conglomerate. You lose value and the investors are always skeptical. This is the reason why Tata Motors is now undergoing a demerger. So now the question is, if the company demerges and the stock price ends up going up, what exactly are the benefits that the company will reap? Well, as it turns out, a higher valuation isn't just about bragging rights, it actually ends up unlocking 3 massive real-world advantages. The first benefit is cheaper money advantage. When a company's stock price is higher, it's actually easier for a company to raise money by selling their shares. Think of dilution like pizza slices. Let's say you own 10 slices of a 100 slice pizza. That's 10% ownership of the pizza. During this time, if the company needs money, they would create 10 new slices and give them to the investors. So they would make the pizza bigger. And now suddenly there are 110 slices in total, but you still only have 10 slices. So if you see, your ownership dropped from 10% to 9.09%. This is called dilution, where your slice of the pie got smaller even though you did not sell anything. Now here's where valuation matters. At lower valuation of, let's say, 2,27,500 crores, raising 10,000 crores means issuing 4.4% new shares. So your ownership gets diluted by 4.4%. But if your company has a higher valuation of 2.7 lakh crores, raising the same 10,000 crores requires issuing only 3.7% new shares. That's 38% less dilution for the same amount of money. And the same 10,000 crores can be raised but without diluting 0.7% of your ownership. Now, although 0.7% seems like a small number, but if you apply this 0.7% to a company that's worth 2.7 lakh crores, that value turns out to be 1,890 crore rupees in shareholder value. The second benefit is the collateral superpower. And here's something that most people don't realize. You see, shares work like property. You can actually use shares as collateral to actually borrow money from the bank. Let's understand this using the housing example. Let's say you own a 1 crore house. Now you can go to the bank and say, you know what bro, I'm not selling my house, but let me use it as security to borrow 50 lakh rupees. So the bank gives you money and you get to keep your house. And the same works with shares also. if Tata Group owns 30% of Tata Motors shares, instead of selling them, they can actually pledge these shares to the banks and borrow money against them. Now, banks typically lend 50% of your share value. So before demerger, if Tata Group's 30% stake is equal to 68,250 crores worth of shares, they can borrow up to 34,125 crores against it. But after demerger, if Tata Group's valuation shoots up by 18%, then the same Tata Group's 30% stake will be worth 81,000 crores. So now they can borrow up to 40,500 crores against it. If you see, that's an extra borrowing power of 6,375 crores, and that too without selling a single share. This is the second benefit of the demerger. The third benefit is the acquisition currency. And here's something fascinating. You know, companies don't always buy other companies with just cash. They sometimes pay them with shares. Let's understand this using example again. Let's say you want to buy your neighbor's land which is worth 50 lakh rupees, but you don't have cash. So you make an offer. So you tell them that you will give them 10% ownership in your 5 crore rupee worth land. So your neighbor gets 50 lakh rupees worth of your land, which is 10% of 5 crores. Now here's the magic. Before this deal, if your land price suddenly jumps to 10 crore rupees, you only need to give 5% ownership to buy the same 50 lakh rupee land. So if your house value goes up, you have to give away less percentage of your land. As a result, you end up keeping more ownership of your property. The same concept applies to companies as well. In this case, if TMPVL wants to acquire a battery technology startup worth 4,200 crores at a lower valuation of 2,27,500 crores, they must give 1.85% of company shares to buy the startup. But at a higher standalone valuation, where TMPVL is valued at 2.7 lakh crores, they must give only 1.55% of the company shares for the same 4,200 crore deal. So if these numbers come true, they will end up saving 0.3% in dilution, which is worth 810 crore rupees. In fact, this is what happened when Facebook bought Instagram for $1 billion in stock in 2012. It gave away less than 1% of its shares because Facebook's valuation was sky high. But if Facebook had been undervalued, it would have cost them 1.5 to 1.8% of the company for the exact same deal. So now the question is it confirmed that both Tata companies will go on to become multi-baggers? Well, not at all. If someone tells you that, they are lying. Because while the demerger has clear benefit, it also comes with a lot of risks. And as investors, you must know about risks more than the opportunity. So let's have a look at all the disadvantages. The first disadvantage is double operating costs. In simple words, running two companies is more expensive than running one company. Because now, the company will require two complete management teams with separate CEOs, separate CFOs and separate CXOs. They will need duplicate infrastructure like two boards of directors, two legal teams, two compliance departments and two investor relation teams. And the additional cost is estimated to be 100 to 200 crore rupees annually. For context, 100 to 200 crore rupees is enough to fund 2 to 3 new EV models or a factory expansion. But now it just goes into administrative cost. The second disadvantage is lost safety net. You see, when times get tough, having diverse businesses under one roof is actually a lifesaver. For example, let's say India enters a recession in 2027 and the commercial vehicle sale drops by 25% due to infrastructure slowdown. In the old structure, the CFO could instantly move 5,000 crores from the passenger vehicle division to support the commercial vehicle division, and no one outside the company would even know about it. But in the new structure, Tata Motors Limited will face the crisis alone with no immediate internal support. For example, when JLR was cyber attacked in September 2025, production got halted and it cost them 50 million pounds per week, which is about 500 crores per week. Now, in the old structure, they could simply tap into commercial vehicles' stable cash flows and instantly they could get the money transferred. But in the new structure, Tata Motors will have to help themselves independently. And here's where a question arises: can't the Tata Group just help them out? What if they're a separate company? Why can't the parent company just step in? Well, that is correct, but it is far more complicated and expensive than simple internal cash transfers. Because to get funds from Tata Group, they will now need formal board meetings, legal approval processes, public disclosure to stock markets, and they will also have to wait for 2 to 4 weeks just for approvals. Now think about it. In a crisis where JLR is losing 500 crores per week, it could be a disaster. The third disadvantage is that there is no guarantee that both entities will succeed. Not all demergers create value because history shows us mixed results. If you look at the eBay-PayPal demerger, PayPal's value jumped from $45 billion to $84 billion. and shareholders celebrated. But if you look at Reliance's demerger in 2005, Mukesh Ambani's RIL thrived to become a 20 lakh crore empire. Anil Ambani's companies collapsed to bankruptcy. So the same strategy could also result into opposite outcomes. So if these companies don't perform well individually, shareholders might wish that they still have the diversified safety of the old structure. This is the story, reason, advantage and disadvantage of Tata Motors' historic demerger. And as a biased Indian, I would always want Tata Motors to win and perhaps to go on to become a market leader in the global automotive space. That's all from my side for today, guys. If you learned something valuable from this heavy case studies, please hit the like button to make YouTube Baba happy. And for more such insightful business and political case studies, please subscribe to our channel. Thank you so much for watching. I will see you in the next one. Bye bye.